Gina, a lot of us woke up this morning. We were looking at those retail sales numbers here, but another report also came at the same time. That was those producer price numbers. We saw inflation, I guess, some semblance of inflation. I guess, is it enough for us to be worried?
No, I think in a nutshell, no. If anything, it's very good news. At this point in the economic cycle, what you want to see is reflating numbers, driving bond yields incrementally higher, widening the yield curve, and contributing to some degree of earnings improvement. And that's exactly what we're seeing. I mean, just in a little bit of perspective, if you look at the PPI, less than 1% year over year, we've been as high as 7% back in 2011. We were 4% in 2018. Those are the types of levels when PPI is, especially when PPI is moving faster than CPI, that you would expect to ultimately filter through into some kind of margin pressure for S&P 500 companies. Instead, you've still got CPI running at a faster pace than PPI. Both numbers are low but reflating, which is indicative of an improving economic environment, generally indicative of an improving earnings environment as well, which is great for the stock market.
Gina, I want to touch on that. We've heard higher yields, higher inflation, higher growth, great for the market, except not really if we're thinking about our discount cash flow models, right? And then the denominator, if it's higher, it means present value is lower. How are you thinking about that?
Yeah, so we do think about that a lot. And, I commend you for asking the question, because I think that people forget about the entirety of the equation when they're talking about that. Yes, the discount rate is a portion of how you value an equity, but you also want to think about future cash flow growth. And if the discount rate is rising, but future cash flow growth is rising more quickly, that ultimately results in higher prices. And that's the situation we're in right now. There's more than one factor that drives stock prices. It's not all about bonds. It's not all about interest rates at large. It's not even all about the yield curve. The earnings landscape is actually incredibly meaningful. And so when you put all of these things together, you've got the likelihood for an improvement in future cash flow growth and a rapidly, exponentially growing improvement in future cash flow growth at this particular stage of the cycle, which is vastly overwhelming these modest increases in inflation and modest increases in interest rates that we're seeing so far.
The investors haven't reacted in sort of a bullish style when earnings are beaten so much. I mean, I don't think we've seen in at least 2 decades such a negative reaction to such stellar earnings when from a profit basis and a sales basis. What do you make of the reaction to earnings?
Yeah, well, what we found is, frankly, the fourth quarter earnings season was astonishingly good, but clearly fourth quarter earnings were priced in. Where we are actually seeing price reactions in the earnings stream is in guidance. What's taken investors by surprise, and I think is really driving stock prices higher, is the fact that companies are not only beating on fourth quarter earnings, the backward-looking data has been good, but they're also telling us that our expectations are too low for 2021. So we've seen guidance, extremely positive guidance come out of corporates, much stronger positive guidance than negative guidance so far this quarter. And we actually are seeing positive price reactions to guidance numbers. We certainly priced in a lot of good news for the fourth quarter, and analysts were caught off guard, but the market was not, by better than expected fourth quarter earnings. Where we've been shocked, frankly, is the fact that companies are telling us, hey, the environment is looking a lot better than we thought it would, and your forecasts for earnings growth into 2021 are too low.
That's interesting, though, but I mean, you do have sort of a certain cadre of companies out there that benefited greatly from the pandemic, or at least during the pandemic. They're going to have some pretty tough comparisons going forward. On top of that, you do have raw materials costs for a lot of companies higher as well. So I am curious as to whether the companies affected by this are going to be enough in critical mass and numbers to maybe have a broader effect on the market.
Yeah, so what you actually saw in 2020 is a very narrow list of companies were beneficiaries of the pandemic, which is why we had such concentration in equity market gains in the mega cap stocks. I mean, we were talking this time last year, we were talking a lot about mega cap companies. Throughout most of 2020, we were talking about very narrow market gains in the Facebooks and Amazons and Googles of the world. What we've seen now is those are the companies that will experience the toughest comps. Those are the companies that are experiencing something of a consolidation in their stock prices, deflating multiples, while the rest of the marketplace catch up. So in sheer numbers, you've got this narrow group of companies that performed very, very well and really dominated performance in the market, both fundamentally and in terms of price in 2020. The rest of the market was left behind. those left behind entities are the primary beneficiaries of an economy that migrates to a more normal operating environment. And their comps are extremely easy. I mean, we had the worst earnings growth in S&P 500 history in the second quarter of last year. That was driven by the distress for these entities, which will face much easier comparisons. At the same time, when you look at those big mega cap companies, their comparisons are tougher, but even their estimate revision is positive, which does tell you that they're not necessarily going to be left behind. They're just more likely going to be a force of stability for the index, while some of the rest of these companies start to play a bit of catch up.
Gina, Bob Michael of JP Morgan said high yield spreads right now to 315, compress further to 300, maybe 250. Is that risk-on signal in the credit markets positive for equities?
Absolutely. Any risk-on signal in the credit markets is very positive, especially for our valuation model. We do run a model for the S&P 500 equity risk premium, which we then back into a multiple expectation. And the BAA credit spread is one of those inputs. So we do have a heavy respect for the signal coming from the bond market in the form of credit spreads. As credit spreads tighten, it's certainly, especially as high yield spreads tighten, it's even more beneficial for small cap companies, which are more closely correlated with the high yield market than large cap companies. But as long as credit spreads are remaining tight or tightening, it's pretty good for equities at large.